Hey everyone, have you ever looked at two different companies and just wondered, how does an investor actually choose? How do they know which one is the better bet? Well, I'll tell you, it's not magic, and it's definitely not just a lucky guess. It's all about having the right tools. And today, we're going to build your core investor toolkit, right from scratch. We'll focus on the key numbers that really drive smart decisions. Okay, let's get into it.
So, here's our game plan. It's a four-parter. We're going to kick things off with the big question every single investor has to ask themselves. Then, we'll build two absolutely essential tools for your kit. First, the yield, which is all about immediate returns, and second, the PE ratio, which kind of lets you see into the future. And finally, we'll flip the whole thing around and look at what's driving the company from the inside out.
You know, it doesn't matter if you are managing billions of dollars or just getting started, every investor's journey begins with the exact same fundamental question.
So let's just imagine it. You've got €1,000 ready to go, you look at the market, and wow, there are so many options. You could pick a brand to use every day, maybe follow a tip you heard from a friend, but how do you make a decision that's actually, smart? How do you really look under the hood of a business?
Well, that's what this is all about. A truly smart decision isn't based on feelings or hype. It's based on real analysis. And to do that, you need the right tools. So come on, let's start building your kit piece by piece.
Okay, our first tool is all about the here and now. It answers a really simple but powerful question. What is this investment going to pay me right now just for owning a piece of it?
And that tool is called the yield. To put it simply, it's the cash payout, the dividend that you get from the company each year. And we measure it as a percentage of what you paid for that share. Think of it like this. It's your immediate, tangible reward for being a shareholder.
Okay, let's make this real. Let's say a company's shares trading for €20. That's the price to buy one piece of the company.
Now, for each one of those €20 shares you own, the company pays you a dividend of €1 per year.
So how do we get the yield? Simple. You just divide that €1 dividend by the €20 share price, and there you have it, a yield of 5%. It's a 5% cash return on your money each year, and that's completely separate from whether the stock price goes up or down.
Now, here's where it gets interesting, because different investors look at this number in totally different ways. On one hand, you've got investors who are hunting for that high yield. They want that regular, immediate income. But on the other hand, you've got investors who couldn't care less about a low yield. They're making a bet that the company is pouring all its cash back into the business to grow like crazy, which could make their shares worth a whole lot more down the road.
All right, tool number one is in the bag. Our second tool, though, shifts our focus away from today's payout and towards tomorrow's potential. See, if yield tells us what a stock pays us, the price-to-earnings ratio, or PE, tells us what the rest of the market expects from it.
But hang on. Before we can really get our heads around the PE ratio, we have to understand its foundation. And that foundation has a name, earnings per share, or EPS for short. It's like the bedrock of all this.
So what is EPS? Well, it cuts through all the big confusing numbers. It just takes a company's total profit after taxes and divides it by the total number of shares out there. And the result tells you exactly how much profit the business made for every single share.
Let's build this out with an example. So let's say our company makes a clean profit of €1 million.
Okay, so that profit gets spread across all of its shares. And in this case, there are 4 million shares in total held by investors.
So you do the math. 1 million in profit divided by 4 million shares means that each share earned 25 cents. And that, my friends, is our earnings per share, a super clear way to see how profitable the company is, one share at a time.
Okay, now we're ready for the PE ratio. You just take the current share price and divide it by that EPS number we just figured out. This one little ratio gives you an amazing snapshot of how expensive a stock is compared to the actual profit it's making.
So let's stick with our example. Remember that share price of €20 from earlier? And we just calculated the EPS as 25 cents? Well, €20 divided by 25 cents. That gives us a PE ratio of 80. So what on earth does a PE of 80 even mean? It means investors are willing to pay 80 times what the company currently earns in a year for just one share. That is a massive vote of confidence. It's a signal that the market is expecting absolutely explosive growth in the future, and people are willing to pay a huge premium today to be a part of it. It's basically a measurement of hype and expectation. So we've got our tools. We know how an investor looks at a company from the outside. But now let's step over to the other side of the table. What's the main mission? What is the one goal that drives every single decision a company's leadership makes? For pretty much any company on the stock market, the #1 directive, the prime directive, is maximizing shareholder value. Every single strategic move they make is seen through one single lens. Will this make our owners, our shareholders, more money, either through bigger dividends or a higher stock price?
And this quote, wow, it just captures the cold, hard logic of that mission, doesn't it? It can lead to some really tough choices, like selling off parts of the business that are actually making money, just not enough money to satisfy shareholders. It's a relentless, nonstop push for maximum profit.
And this whole philosophy, it basically becomes the company's DNA. Every big decision they make, buying another company, selling a division that isn't performing well enough, or just finding new ways to squeeze more profit out of what they already have, it's all guided by that one single goal: boost that shareholder value.
And that's really where this leaves us. We now have the tools that investors use, and we understand the core goal that drives the companies they invest in. But all of this brings up a much, much bigger question, one for us to think about. If a company is laser-focused on just one thing, returns for its shareholders, what are the ripple effects? What does that mean for the employees who work there, the customers who buy from them, and the communities they're a part of? Something to chew on. Thanks for joining me.